Welcome you to another deep dive. Today, we're really tearing into a compelling topic that's been making some serious waves. We're talking about the Sui Network and its SUI token. And we've pulled together quite the stack of sources, everything from the core technical white papers, deep economic analyses, developer insights, market reports, you name it. Our mission, as always, is to distill all of this down into something clear, actionable, really giving you a shortcut to understanding what makes Sui tick. You know, why it matters, where it might be headed. We'll explore its unique design, unpack how its economy works, and what it means for you if you're looking to understand or maybe even engage with this ecosystem. And believe me, this is where it gets really interesting.
It really does. I mean, what's fascinating here is that Sui is a layer 1 blockchain, like Ethereum or Solana. But, and this is the key thing, it takes a fundamentally different approach, almost revolutionary, you could say. We'll trace its roots back to developers who used to work on blockchain at Meta Facebook previously. And you can really see how that background, that experience, has profoundly shaped its core architecture and, frankly, its capabilities.
Okay, right. Let's unpack that foundation then, because it does sound like a real departure. You mentioned it's different from traditional blockchains. They often work like a single-lane road, right?
Yeah.
One transaction after another. But Sui, you're saying it's more like a multi-lane highway.
That's a perfect analogy, actually. Sui's defining characteristic is what they call its object-centric model. So instead of just accounts and balances, think of every single piece of data, a user's wallet, a token, a smart contract, as an independent object. Each one gets its own unique ID. Now, these objects can be owned privately by an account, or they can be shared across the network.
Okay, owned or shared. What's the implication of that?
Well, here's the clever part. Operations on those privately owned objects, they're simpler. Crucially, they don't need the whole network to agree, no network-wide consensus. That makes them super efficient. Shared objects, like you'd find in a DeFi app where lots of people interact, those do need consensus. But this whole object-based design, it's what allows for incredible scalability and speed. It enables true parallel execution. Think of those highway lanes, multiple transactions happening simultaneously, not stuck in one long queue.
Wow, okay. That is a huge shift. And the language behind all this, the programming language.
It's Move.
You got it, Move.
Right.
It's based on Rust. And it was originally developed at Meta specifically for handling digital assets safely. It's got really strict rules about object ownership, how their state can change. It's built for security.
How does Sui's version differ? I think Aptos uses Move, too. Good point. Yes, Aptos also uses Move, but Sui's version takes it a step further. It explicitly defines whether an object is owned, shared, mutable, meaning changeable, or immutable, meaning fixed. That extra clarity isn't just, a technical detail. It adds another layer of security and predictability for developers, makes it much harder to accidentally introduce bugs or misuse assets. It's about peace of mind, really.
Makes sense. So, okay, you've got all these parallel transactions firing off. How does Sui keep it all secure? How does everyone agree on what's valid? That sounds challenging.
It is, and that brings us to consensus. Sui uses proof of stake, like many modern chains, but with its own unique twist. It's really a two-part system working together. First, there's something called Narwhal.
Narwhal, like the whale.
Exactly. Think of Narwhal as a super-fast mempool or a data availability engine. It ensures transactions are available and ordered efficiently for processing. Then there's Tusk, or sometimes they call it Bull Shark. That's the actual consensus protocol, the Byzantine fault tolerance part.
Okay, Tusk or Bull Shark. So that's the part, making sure everyone agrees, even if some validators are offline or trying to cheat.
Precisely. It's how the network stays secure and correct. And this whole setup is asynchronous. That means it's very resilient. It can handle things like denial of service attacks much better than some other designs. It just keeps running smoothly.
All right, so lightning fast, object-centric, secure, quite the foundation. But what actually fuels this thing? Let's talk about the SUI token itself. What's its role in this whole ecosystem?
Right, the SUI token. It's absolutely central. It's the native asset, the lifeblood, really. First off, you use SUI to pay for gas fees. That covers computation, processing the transaction, and data storage costs on the network. Second, it's key for staking. SUI holders can lock up their tokens, delegate them to validators, help secure the network through proof of stake.
And earn rewards for doing that, presumably.
Exactly, you earn rewards. Third, holding SUI gives you governance rights. You get a say in protocol upgrades, network decisions, that sort of thing. And finally, it's just a versatile liquid asset within the Sui ecosystem itself. Unit of account, medium of exchange, store of value, all the standard crypto functions.
Now, one thing people always ask about tokens is the supply. Is there a limit? Can they just keep printing more SUI.
That's a crucial point for predictability, you're right. SUI has a hard cap, a fixed maximum supply of 10 billion SUI tokens. That's it. No more can ever be minted.
10 billion. Okay. That contrasts with some others, right? Like Aptos or Solana. They don't have a max cap.
Correct. Aptos and Solana, for instance, don't have a fixed maximum supply. Their issuance can continue indefinitely, though they might have burn mechanisms to offset it. SUI's cap is absolute.
Wait, hang on. Not all 10 billion are floating around right now, are they? I remember seeing something about allocations and unlock schedules.
Exactly right. While the total supply is capped, the circulating supply is managed carefully. They use a structured vesting schedule. It's designed to, ensure stability and encourage long-term commitment.
How did that break down? Where did the initial tokens go?
So roughly half, 50%, is in a community reserve. That's for grants, ecosystem development, things like that. Early contributors got about 20%. Investors from their funding rounds, Series A and B, got about 14%. Miston Labs Treasury hold around 10%. And then a smaller slice, about 6%, was for something called the Community Access Program.
And these tokens aren't just released all at once.
No, definitely not. They unlock over time. Actually, a huge chunk, over 50% of the total supply, isn't scheduled for release until after 2030. In the shorter term, you see specific unlock events. Like, I think in early January 2025, there were a couple of unlocks. One was about 64 million SUI, another about 74 million. Small percentages of the total supply, but still significant dollar amounts potentially hitting the market.
So planned unlocks, transparent, but definitely something for people to be aware of if they're tracking the supply. It's also interesting, that SUI specifically decided not to do a big airdrop at launch. That's pretty common these days. Why skip it?
Yeah, that was a very deliberate choice. They cited a few reasons. One was mitigating risks from, bad actors trying to game the system. Another was avoiding potential tax headaches in different countries. But fundamentally, they said they wanted to prioritize the long-term health and success of the network over just generating short-term hype. It really signals a focus on building something sustainable.
Okay, that makes sense. Let's switch gears slightly and talk about deflation. It's a buzzword in crypto. Some projects burn tokens to reduce supply. How does SUI handle this, especially with its fixed supply? Is there a burn mechanism?
It's handled very differently. SUI doesn't have a traditional burn where tokens are sent to an unspendable address and destroyed forever. Instead, it has this really unique feature called the storage fund.
Storage fund.
Yeah.
Okay, how does that work?
Right. So when you do a transaction on SUI that adds data to the chain, like minting an NFT or storing application state, part of your gas fee, specifically the storage fee, goes into this fund. Now, here's the cool part. The storage fund itself stakes the SUI it collects. It acts like a giant staker, earning rewards.
The fund earns staking rewards.
Okay.
Then what happens to those rewards?
Those rewards are distributed to the validators, both current and future ones. It's basically to compensate them for the ongoing cost of storing all that data indefinitely. So in a way, users who created data in the past are effectively paying future validators to keep storing it.
That's actually really clever. It's like a self-funding mechanism for data storage. But does it reduce the supply? Is it deflationary?
Well, it does reduce the circulating supply because SUI tokens get locked up in this fund. Now, here's another twist. If you later delete data you previously stored, you can actually get a partial rebate of the storage fees you originally paid.
Oh, interesting. So those tokens can come back into circulation.
Some of them can, yes. So the storage fund creates both a temporary deflationary effect by locking up SUI and what you might call a quasi-permanent one. The temporary effect is stronger because more SUI is initially locked up. The quasi-permanent bit comes from parts of the fund's capital and some leftover bits from rebates that are designed to stay locked up forever.
So it's not a pure burn, but it does take tokens out of active circulation potentially for a long time or even quasi-permanently in some cases.
Exactly. It creates an incentive to be efficient with data storage because you pay for it up front, but you get some back if you clean up later. And it helps manage the overall token supply dynamics.
Okay, so putting it all together, the fixed supply, the vesting schedule, this storage fund mechanism. What's the overall picture for SUI's inflation or deflation?
Well, looking at the big picture, SUI definitely still faces significant inflationary pressure in the near to medium term. Remember, something like 70% of the total supply still hasn't been released. We're talking about roughly 1.8 billion SUI potentially entering circulation by 2030.
Right, those vesting unlocks.
Exactly. However, the network could potentially become deflationary further down the line, especially after May 2026, when the rate of new token releases slows down quite a bit. But even then, because of that rebate mechanism for the storage fund, it's probably best described as semi-deflationary or maybe pseudo-deflationary. Those locked tokens can return. So its actual deflationary impact really depends on how you define the term and how much data gets stored versus deleted over time. It's a dynamic balance.
Yeah, it's more nuanced than just inflationary or deflationary.
Yeah.
Okay, moving beyond just the token supply, how does SUI's economic model actually incentivize the validators? Keep them honest, keep them competing, keep the network running efficiently.
That's another area where they've put a lot of thought into the design. The gas fee mechanism is key here. It aims for low, predictable transaction costs for users, which is great for adoption, while also making sure validators are rewarded for being efficient and reliable. Remember, gas fees have two parts: computation fees for processing and storage fees for data. Storage fees are set per epoch, while computation fees can fluctuate a bit more based on demand.
Predictable fees sound great, but how do they actually set those fees and make sure validators play ball? What stops them from charging really high prices?
Right. So at the start of each epoch, usually 24 hours, validators submit a quote, basically the minimum gas price they're willing to accept to process transactions. The protocol looks at all these quotes and says a network-wide reference gas price. It's based on the 23rd percentile. So most validators are willing to process at or below this price.
Okay, so there's a benchmark.
Exactly. And this gives users stability. If you submit your transaction near that reference price, you can be pretty confident it'll get processed quickly. Now, the really novel part is how validator rewards work. Unlike some systems where block rewards can be a bit random, on SUI, all honest validators get their staking rewards with full certainty.
Full certainty. Based on what?
Based purely on their amount of stake. This avoids that rich get richer dynamic where the biggest stakers just keep getting luckier with rewards. But here's the incentive twist. Validators are directly motivated to offer low gas price quotes and process transactions quickly. Why? Because their rewards get boosted if they submit low quotes and execute efficiently.
So they make more if they're competitive and perform well.
Precisely. And conversely, they get penalized if they quote low, but then fail to process. Direct economic feedback loop rewarding good behavior.
And users delegate their SUI to these validators, right?
Yeah.
In staking pools.
Yes, validators run staking pools, and users delegate SUI to them. And there was a recent upgrade, SIP 39, I think it was called, that actually makes it easier to become a validator. Instead of needing a huge fixed amount of SUI, the requirement is shifting towards voting power, which is based on your stake relative to the total network stake. So, for example, you need at least 3 voting power units to join the active set. It lowers the barrier to entry while still ensuring validators have skin in the game.
That sounds like a really well thought out system. Fair rewards, incentives for efficiency, predictable costs for users, and making validation more accessible. So we have this robust technical design, this clever economic model.
Yeah.
What's actually happening on SUI? What does the ecosystem look like? Is it growing?
Oh, it's definitely growing, explosively, especially in DeFi, decentralized finance. The numbers are pretty staggering. Some projections see the DeFi market on SUI potentially growing from around $55 billion in 2022 to maybe over $330 billion by 2030. That's massive growth.
Wow. And what about now? What's the TVL?
The total value locked, yeah. It's been on a steady, steep climb. By January 2024, it had already broken past $280 million. And the SUI Foundation is actively pouring fuel on this fire. They have big programs funding developers and projects, plus significant SUI token incentives for the top DeFi protocols.
So incentives driving liquidity potentially boosting the token price.
Yeah.
That classic crypto virtuous cycle.
Pretty much, yeah. It seems to be working.
Can you give us a flavor of the projects thriving there? Any interesting examples?
Sure. There's quite a variety. You've got NEVI Protocol, for instance. It's a lending platform that's growing really fast. What's neat there is users can earn incentives on both deposits and loans for assets like SUI, USDC, USDT. Sometimes the deposit rate is even higher than the borrowing rate, allowing for some arbitrage.
Huh. Any governance token for NAVI yet?
Not yet, which is interesting. That often leads people to speculate about potential airdrops for early users down the line, you know?
Right, the airdrop farming angle.
Yeah.
What else?
Then there's Cetus. That's the biggest decentralized exchange, the biggest DX on SUI right now.
Yeah.
It uses a model similar to Uniswap v3 with concentrated liquidity. This makes capital very efficient. And it's generating pretty impressive returns from trading fees alone. Some of their SUI USDC pools have shown really high APRs just from fees, plus additional SUI token rewards on top.
High APRs. Always catches the eye. Any others worth mentioning quickly?
Yeah, definitely. There's Scallop. another lending protocol offering SUI rewards, often around 20% APR for deposits, like NAVI, no token yet. There's DeepBook, which is an order book DX actually built by the SUI Foundation itself, meant as a public good for other protocols to build on. FlowX Finance is another DX rewarding liquidity providers with SUI, particularly stablecoin pairs. Aftermath Finance offers liquid staking tokens and an aggregator. CreaDex does spot and perpetuals. The list goes on. It's a busy space.
It certainly sounds vibrant. What about users? Is it all just DeFi traders?
Actually, no. The community seems quite diverse. Estimates suggest maybe 45% are regular traders, 30% focus purely on DeFi, but then you have 15% NFT collectors and even 10% gamers. So it's definitely seeing adoption beyond just finance, which is a healthy sign. Gaming platforms are emerging, leveraging SUI's speed for things like player-owned assets and instant reward payouts.
That diversification is key, I agree. Okay, so lots of potential, lots of growth. We always need to talk about the risks. For you listening, what are the potential downsides or things to be cautious about with SUI?
Absolutely crucial. Promise is one thing, risk is another. You need to be aware. First, you have the general crypto risks that apply everywhere. Market volatility is huge. Liquidity can dry up. There's always the risk of bugs in the code or smart contract vulnerabilities, cybersecurity threats. Standard stuff.
Regulation too, right?
Definitely. Regulatory environments are all over the place depending on where you live. You need to know the rules for DeFi in your own country. Then there are SUI-specific risks. Competition is fierce. Ethereum, Solana, Polkadot, Aptos, many other layer 1s are vying for the same users and developers. SUI's long-term value depends heavily on winning significant market share.
Makes sense. What else?
There's developer dependence. While many teams are building now, continued strong development of the core infrastructure and the dApp ecosystem is vital. And finally, staking SUI. Yes, it offers rewards, but it doesn't eliminate risk. Your yield is paid in SUI tokens, right? The value of those tokens in dollars, or whatever your base currency is, isn't guaranteed to go up just because you have more tokens. Market risk is always there.
Right. Yield in the native token is great, but its ultimate value depends on the market. So the classic caveat emptor, buyer beware, definitely applies here too.
Always. It's about being informed, understanding the trade-offs.
Well, we have certainly covered a lot of ground today. We've really dug deep into SUI, unpacked that unique object-centric design, explored the tokenomics, the storage fund, the whole deflation debate, and looked at the ecosystem that's booming on top of it.
Yeah, connecting it all, SUI really is a major attempt to tackle those big blockchain challenges, scalability, user experience, using some genuinely novel ideas in its architecture and its economic incentives. That focus on predictable gas fees, the sustainable storage model, it definitely makes it stand out from the crowd.
It's complex, no doubt, but also really innovative. What's the one thing that really sticks with you after diving into all this?
For me, it might be that deep integration of the storage economics directly into the core protocol. That's quite unique.
Interesting. Okay, so as you, our listener, think about how these kinds of layer 1 innovations might shape the future. Here's a final thought to chew on. If networks like SUI truly can scale efficiently, handle massive throughput, and offer seamless, cheap digital interactions for potentially billions of users, what kinds of applications, things we maybe can't even imagine properly yet, could finally become feasible? How might that fundamentally change how we interact with digital assets, with services, on a truly global scale? Something to ponder. That's all for this deep dive. Until next time, keep learning, keep questioning, and keep exploring.